like I'm pre-existing bone that was evident. That's evidence of black excellence. I can tell a good dog when I'm missing them. Know that if I had to try to be protecting them. Mother of a child of God, I invest in them. Nutrition, brown milk, and milk. Young girls and young people keep marching. Hey, hey, hey. Floodgates coming, never just stop. Hey, come on in. Come on in. Happy Money Monday. Happy Money Monday. Hang on in there. How y'all doing? It's Money Monday. All my rules say evident. Hard work, better know, ain't no changing it. Popping out on the charts, that's the better way. And popping out. Hey, Empress, happy Money Monday. All right, Alexa, cancel. Alexa, cancel. Hey, it is Money Monday, and today we are going to be talking about your debt, right? We're going to talk about how your debt is impacting your credit score and whether or not if you should keep looking at it or if you should actually pay it, right? That's what we're going to be talking about. That sounds like a really simple answer, whether if you should pay it or not. But oftentimes I'm sitting with my clients and they're thinking, okay, Shani, should I just have this debt deleted? Should I just pay this debt? Should I just sit at it and wait for it to come off in 7 years through the process of osmosis, right? So today I have with us one of our partners. His name is Marc Williams. He is a long-time lender, and we're going to bring him into the conversation to talk with us about whether or not if we should pay this debt, whether or not if when he looks at the debt, what amounts is he's willing to dismiss, or does he still want to give you the loan to get that investment property, to get your first home, or to get yourself another house. All right, sis? Okay, so before we bring Marc into the episode, we want you to do what you always do as soon as you come in my presence, right? We want you to open up your spiritual purse. We want you to open up your actual purse. We want you to open up whichever purse that makes you feel richer. And you need to open it up because I'm about to give you some money. You ready? You ready, sis? You ready? All right, now, you know, sometimes my machine acts a little ghetto, and we know how to revert really quickly. All right, so depending on what type of mood it's in, we're not gonna worry about it because we already got a process in place to make sure that you get paid, all right? So open up your spiritual purse, your actual purse, whichever purse at this moment that makes you feel the richest, and I'm gonna give you some money, honey. You ready? Real ghetto today. I'm gonna have to do it the way you know how they do it, sis. You know I'm about to give you the money, sis. You better receive it, sis. You better receive that money because that's how you're gonna feel when you finish with this episode. You are going to at least get one thing that's going to add some value to your purse. So if you have any questions about home ownership or how your debt is impacting your credit score and stopping you from getting some of the things that you really would like to be able to experience, we're gonna get those questions answered for you today. All right, Marc, come on in. Hey, Marc.
Shani, how you doing?
Thanks for joining us today. Thanks for hanging out with us and adding some value to our purse. I know that you are a long-time lender and you have been providing home ownership to people in South Florida for over a decade. So thank you so much for sitting in with us and sharing some of your perspective, and not just perspective, but actuality.
Absolutely. So glad to be here.
All right, Marc. So let me ask you the first question that many of my clients ask me. They're always asking me, Shani, should I pay this debt or just let it sit here? And as a lender, to someone who gives money to people, how do you feel about the debt that's just sitting on those credit reports?
So great question. And, when we're talking about the actual debt for a person, there's something that I really want folks to really take away. And that is looking at their debt to income ratios, because that's what we as a lender are going to do. And here's what I mean by that. Of course, we want clients to be paying their debt on time, right? As much as possible. Now, if some of that debt can be negotiated with merchant or creditor, then by all means, see if they can do that to be able to hopefully lower their debt and not tap into so much of that discretionary income that they have in order to hopefully increase their affordability for buying a home. So when we say ratios, there's guidelines depending on the type of loan product that we have for the client on whether or not they need to be below or if they're exceeding that ratio a little bit. And that ratio is a percentage of their income, and it looks at their debt plus whatever we have estimated for their monthly mortgage payment. So when I say that, let's say, for example, with their debts, their minimum monthly payments, and their monthly mortgage payment that's estimated, it's $1,500. As long as that $1,500 total does not exceed, let's say, about 45% of their discretionary income or their income, their gross monthly income, then they'll fall in line. So I always urge clients to reduce that debt and have a little bit more discretionary income that can be used towards qualifying them and increasing their affordability. But we definitely want clients to hopefully resolve some of that debt, bring it down, but really making sure that they're paying that debt on time.
Okay. All right. So you want to make sure that debt is being paid on time. And then you want to, let's break down this language of DTI because it's used very frequently. So let's just break it down in a simple way. That debt to income ratio, what is it? What are the variables that create that?
Great question. So when we're looking at that debt to income ratio, what we're going to calculate is their gross monthly income. So every client should know what their gross monthly income is. And you basically will take your annual income, and if you're paid bi-weekly, then you're going to divide that by the 12 months, right? Or 12 months total. And then you're going to hopefully get a good estimate of what your gross monthly income is. So whatever that gross monthly income is, we're going to divide that into the actual estimated monthly mortgage payment and the actual debts, the minimum monthly payments that you're making on those debts, to be able to calculate that debt to income ratio. And as long as that percentage, whatever that percentage is within that 45%, and sometimes it can be a little bit higher ratio, then you'll be fine.
Got it. Okay, so that's ratios. Got it. Correct. Now, what is something that when you look at a credit report and you just know, like, I can't give these people no money. Like, I can't do it. What are some things that when you, because that's what it comes down to. I think that when people are looking for home ownership, I think what you should hear in the back of your mind when you're applying for a credit card, when you're going to get a loan, whatever financial instrument, you're asking people for money. That is essentially what you're doing. You're asking them for money that you currently do not have.
Correct.
You don't have 150, you don't have 250, you don't have 350. So when someone is asking you to borrow money with the collateral being a home, and you look at their credit report, what are some of the things that you look at and you like, I can't do nothing with this?
So that's also really good. And I would say that you got to understand what's on your credit, right? So if you have any judgments, any bankruptcies that haven't been resolved, and when I say judgments or even collections, if they're over $2,000, we really need you to either settle that debt or negotiate some sort of repayment plan with that merchant. Okay. Now, on a bankruptcy, if it's 2 years from the date of discharge, and in some cases it can be 1 year, but typically 2 years from the date of the actual discharge, we can help you and still work with you. So we're going to be looking for items like that. Remember, it's all about that payment history, making sure that you're paying it on time, making sure that there's not any unresolved large judgments or collections, and really making sure that if you've been late in the last 30 days or 60 days very recently, that you're back on track making the payment on time. Because we as a lender, if you're paying your merchants late or there's been some missed payments without a true explanation, we're going to take that into consideration, and we may very well need a letter of explanation or a little bit more clarity on exactly what happened with your financial situation. Now, we understand that, everyone's unfortunately going through COVID, right? And what's happening with COVID as it relates to furloughs and being unemployed. So we are going to take some of that into consideration if you're helping us to explain that scenario and what happened with your finances. But those are the things that will hold us back from really lending any money. And if your ratios are not there as well, and they're not meeting the guidelines that we need them to make, that can also make it difficult for us to lend.
All right, so for those of you that are taking notes, here's some of the things that Mark says that when he's looking at your credit report, he's gonna go, okay, sis, not right now, I'm not lending you no money, okay? So if he's looking at a bankruptcy that you've had recently within the last year, at that time, he's not going to want, he's not going to want you alone, okay? At that time, he's not gonna want to give you any money to purchase a house. Another thing that he's looking at is if you had some late payments. Late payments will drop your credit score anywhere from 15 to 30 points.
Absolutely.
So if you're late in January, late in April, late in December, every single time report is being impacted. So what he's saying, as someone who loans money, what he's looking at, if you're not paying your credit cards, if you're not paying your mortgage, if you're not paying your car payment, then maybe you're not going to pay this mortgage either. So he doesn't want to see bankruptcies, younger than 2 years. He doesn't want to see you being late on your car payment, and he doesn't want to see your debt to income ratio maxed out, meaning the amount of debt that you have, it's imbalanced with the amount of income that you have. So the amount that's left over, when you do those numbers, debt versus your income, meaning your expenses, that's not something you need to speak with the lender about. That's something you can do on your own. You can simply just write down all of your monthly expenses and then look at your income. How much money do you have left over? Is it 200? Is it 300? Is it 400? Because they need to know that if something happens when they give you this loan, that you have a little bit of space, right? You need that 8 to 9 months. So those are some really extra, some really good points about lending when it comes to that. Now, tell me about the type of behaviors that you like to see when you're looking at your client's credit reports, and you're saying, "Gosh, this person is ready for home ownership." What's on your credit report?
Great. And it will go right back to paying their bills on time. So we'll be looking at the amount of debt that the individual has as well. So are they maxing out that credit limit? That's one thing that we'll look at as well. So for example, if an individual has a credit limit on a Macy's credit card or a JCPenney credit card of $1,000, if they're maxing that out to $990 or what have you, that's also going to be something that we're going to be looking at, how they are managing their debt, but mostly that payment history. Are they paying that debt on time? And overall, are there any student loans? Those are some of the things that we're going to be looking at as well, which I know we'll probably talk a little bit about. But I will tell you, we are going to be looking at income and paying those debts on time, and also making sure that the client isn't highly leveraged in that debt. As I gave the example related to the Macy's and the JCPenney cards, making sure that they are not maxing out that debt and they have room to be able to lower their payments and keep that debt to income ratio where it needs to be. So we're going to be looking at over all of that. And for example, a lot of clients might be buying a home with their significant other. We're also going to be looking at the significant other's debt as well, to making sure that based on all the income in the household, that it's not exceeding those ratios and that they're not highly leveraged. So those are some of the great things I'm going to be looking at. And then also making sure that the client is not only looking at their credit report, but also looking at how much money have they actually saved. You talk a lot about this, and those are some of the things that we're going to review as well. Are you saving the money? Do you have a consistent pattern with saving your money? And we're going to be looking at the bank statement. So ideally, I want to see great credit. I also want to see how they're managing their overall debt, but also how they're saving and making sure that they're online. And believe it or not, I've also had clients that believe that they'll qualify, and they'll submit a bank statement, and the bank statement is negative $15. They're not ready. So we urge clients to really put aside some money, save what you need to save, but also making sure that you're paying your debt on time.
Sounds good. Natasha, can you look more into his mic because I wasn't hearing him as well? Can you adjust Mark's mic, please? Okay, so we do have a few questions coming in. Specifically, there is one from Cindy and there's also one from Ivy. The one coming from Cindy is specifically about student loans. She wants to talk about how her student loans, what if your student loans are the only real debt you have outside of your car payment, then what? Should you consider putting them in deferment is what she wants to know.
Okay. Good question from Cindy, I think it is. So I would say that
mic needs to be adjusted because we can't hear him. Can I get some comments about whether or not if you can hear him with his mic? Someone comment, let me know that you can hear him clearly. Go ahead, Mark.
I'll speak up a little bit louder and hopefully this helps as well. What I was saying with that as it relates to the deferment and student loans, what we're going to be looking at is making sure that if it is in deferment, what that payment would still be out of deferment, okay? Now, we understand that a lot of clients are, due to COVID-19, having their loan in deferment or a forbearance, and that's okay. But depending upon the type of loan product that they're qualified for will determine a lot of how we are going to look at either counting that payment or acknowledging whether it is in deferment. So if you are thinking about buying a home and keeping that loan in deferment, please realize that we may need to contact your student loan provider and see exactly what that payment would be if it is not any longer in a deferment status or in a forbearance status.
So a question that I'm constantly getting, Cindy, that one is one that typically comes in about, should I be paying my student loan debt while I'm looking to go and purchase a home, that they're thinking about that. But what I want to just kind of just set like a blanket statement is that anything that you're not paying is going to suggest to a lender that you're not going to pay them. Anything. It doesn't matter what it is, your credit cards, medical debt, whatever it is. So anything, any kind of thing you have that you're not paying, they're going to look at your ability to kind of not pay your mortgage. Okay. We also had a really great question that came from Ivy. Advice for business owners when doing their taxes. Typically, they want to write up as much as possible to keep their tax obligations low. Yes, that's a great question. Thank you, Ivy. Can you talk about that? I've seen that too.
Right. So, when we're talking about tax returns, right, one of the top advices I can give is definitely, if you're a small business owner and you're not paying your taxes, or you don't necessarily have an accountant or a CPA in place, I would really suggest doing that. There are a lot of individuals that take their taxes to their tax preparer, and sometimes the tax preparer isn't giving the complete breakdown of what they basically need to look at. So we are going to request what we call a profit and loss statement. So that profit and loss statement is going to be really important for the last 2 years, at least, that hopefully you've been in business longer than that. But for the last 2 years, we're going to be looking at that profit and loss statement and looking at the profit that you're bringing in and whatever expenses that you may have. So to the question, a lot of people take a lot of deductions in the belief that, you know what,